Ajay Shah, Senior Fellow at NIPFP, joins us on board. Ajay, hi, morning. And whatever the government seems to be indicating and doing, yesterday we heard the Finance Minister as well say that the government is going to continue to, put measures in place to control the rupee volatility. That doesn't seem to be helping at all.
We have many problems in the country, and this was one fight that we did not need to pick. It is very costly trying to do anything about the exchange rate. There is no free lunch. So if you try to use policy levers to make a difference to the exchange rate, they have many other adverse impacts. For example, you hit financial development. For example, you get criminality of gold smuggling. For example, you raise interest rates. All these things have costs. So the cost benefit analysis seems a bit odd to me. It is very costly picking this fight, particularly at a time like this.
Ajay, in the past, when a similar situation had surfaced up in 90s, there were two important measures which government announced. First, Reserve Bank of India, they increased rates and they had let the currency devaluate by about 20%. Do you think something similar needs to be done? Currency, of course, has broken down, but now it is time to really increase rates, something which you mentioned last time when we interacted?
Yeah, I just want all of us to be clear-headed about this. For example, look back at 1998. On the 16th of January 1998, Bimal Jalan raised rates by 200 basis points in defending the exchange rate. Now, this was the time of the Asian crisis. The whole world was falling apart. Was it really a very good thing for the Indian economy for monetary policy to tighten at that point? I would question that. I think we would have been better off if there had been no defense of the exchange rate at that point. In similar fashion, I would argue that our thinking about monetary policy should be shaped by inflation and only inflation. We have a huge mess going on with inflation. We have an inflation crisis of major proportions. But if we go try to take a poke at the exchange rate, it just generates a bigger mess. I will show you so many things which have been done in recent weeks, which are about trying to do exchange rate policy, which have nothing to do with inflation, which have nothing to do with monetary policy. For example, what was the need to damage India's financial development by hitting the currency futures market? For example, what was the need to go after capital controls on gold? And so on. Each of these things have costs. The really deep insight is that it is important to let the market and only the market figure out what is the correct exchange rate for the country.
So what is a plausible current exchange rate for the country, and what is going to be a stable rate according to you?
I know as little about what is the correct level of the rupee as I know about the Nifty. Okay, so when you ask me what is the correct level of Nifty, I know absolutely nothing. I'm an economist. I know nothing about what the Nifty should be. If I knew something about Nifty, I would be trading it in a hedge fund. In similar fashion, nobody, I repeat, nobody knows what is the correct value of the rupee. This is what markets do. We should respect the outcome.
Ajay, now Reserve Bank of India was also trying to take the speculative froth out of the currency market because they've increased call rates, and if call rates have gone up, cost of borrowing in the system will go up. Do you think that is more like a band-aid approach, more like a short-term fix?
I'm totally uncomfortable with words like speculative froth. What financial markets do is price discovery by speculation. That is the job of financial markets. Lots of people participate in an open market. Some people think it will go up. Some people think it will go down. People put their money where their mouth is. And the outcome comes out, which is the price. That is what financial markets do. That is the business of financial markets. Now, a central bank can always try to prop up the local currency by doing an interest rate defense. Okay, so if we raise interest rates in India and if we decontrol the bond market, then when we raise rates, more money will flow into India, and that will give us an appreciation of the rupee. We can do that. That's a choice we have to take. But the question is, do you really want to devote monetary policy to chasing the exchange rate, or do you have better things to do with monetary policy?
Ajay, do you think the CAD correction could be a painful process and it will only happen at an extended period of time? I mean, there is no quick fix. CAD is in a mess and there is nothing you can do in a quarter, in 10 days or in a week.
That's absolutely correct. The CAD will respond slowly to the exchange rate. Okay, a big exchange rate depreciation in the long term will help improve exports and will help reduce imports. The other big dimension of the CAD is that in terms of macro balances, the CAD responds to the fiscal deficit. So if we run tight fiscal policy, we will get a smaller CAD. These are slow things. These are long-term things. Again, we should let them play out. It's like the patient has a fever. We should not be giving a medicine to bring down the fever, because the fever is a part of the body's response on how we fight the infection. Similarly, rupee depreciation is how the CAD comes back. It takes time, but that doesn't mean we should try to prevent the rupee depreciation.
Ajay, do you think we now really need to have some kind of an import duty mechanism going when it comes to luxury goods? Have a stronger import duty or a higher import duty on iPads, iPhone, mobile phones, TV, plasma TVs. It is important to curb consumption, and if consumption does not go down, we could be in a spot of bother further.
I get this sense of deja vu, like I heard these discussions 20 years ago. We used to talk about these kinds of things 20 years ago, where there would be some central planner who would decide that importing Brill cream is good or importing Brill cream is not good. I think that we should be doing trade liberalization. It is not the job of government to decide what to import and what not to import.
So what is the easy way out?
There is no easy way out. We should allow the rupee to move. We should allow the currency market to discover the price of the rupee.
But in order to do that, your balance sheet in the short term could take a hit. If your balance sheet in the short term could take a hit, rating agencies will come back. They'll threaten a downgrade. Can we afford that?
Okay, let's be clear on what balance sheets we're talking about. Let's go step by step. First, let's think of the government. The government has no dollar-denominated borrowing. There is no original sin by the government. So there is no problem. Rupee depreciation does not threaten the solvency of the government. There is some indirect effect because of subsidies, that when there is a rupee depreciation, the government spends more on, say, the fertilizer subsidy. That's a great reason for removing the fertilizer subsidy. That's what we should be doing. Okay, now we turn to the corporations. There is a lot of loose talk about balance sheet exposures of the corporations. I think that's just loose talk. If we go look inside the data and we carefully analyze the exchange rate exposure of the companies of India, we recently processed data for the top 1300 companies of India, and we find a remarkable pair of facts. The first fact is that there are almost no companies who stand to lose from rupee depreciation. The second fact is roughly 1/10 of the companies actually stand to gain from rupee depreciation. So I think that the notion that India has a balance sheet exposure and we should be worried about rupee depreciation, I don't think this is factually correct.
Ajay, I know you have a packed ahead, so would let you go. And every time I interact with you, I get to learn something. You always give a new dimension to what should be done to fix the macro. So I certainly hope to see more of you going forward.